today we're talking about ideas to alpha, and in trying to frame this this kind of conversation around small caps, I was thinking, how do I communicate very simply our true north? And it just occurred to us that we usually start with a quote, but this time, rather than starting with Warren Buffett, we thought we'd start with the teacher of the teachers. If you trawl through Warren Buffett's notes and books and annals and commentary, you'll find him refer to a guy called John Burr Williams in a book called The Theory of Investment Value. This is where Buffett gets his core idea about cash flows. And if you read through that tome of book, you'll find somewhere buried in there that the value of any stock is basically a sum of its cash flows now and into the future, discounted at some appropriate cash flow rate. It's also a great way of comparing investment ideas. So if you're comparing property, small caps, large caps, Bitcoin, look, if you go back to cash flow, it's one really good way of sifting the wheat from the chaff, and so it's really the core of what we do. To test that idea, we thought we'd go through and say, let's go back and look at small caps over time in Australia and do a simple back test looking at cash flow companies and cash flow negative companies. And if you do that using Bloomberg, this is all the companies in the small cap space between 50 million and 3 billion over 20 years. And you just build a portfolio of companies with positive operating cash flow. No valuation work, no industry analysis, and nothing else that we do at Spheria. You get the light blue line here. So you get material outperformance versus the index, which is the grey line. And conversely, flip it around and say, okay, if you only want to buy stocks that were losing operating cash flow, how would you have done? And you get the red line. So that tells us a couple of things. Don't buy cash flow losing companies over time. And secondly, it's as important about what you own as what you don't own in terms of how you derive alpha in the small cap space. So it won't surprise you then that the bedrock of what we do, Kyle's already stolen my thunder here, but it's basically cash flow. So we look for free cash flow businesses. We think this approach helps us deal with companies that are cyclical, turnarounds, growth stocks, and also importantly, we think it's applicable to any future technologies that might come in. We can take our approach to investing and bring in things like AI in the future, which I'll talk about a bit later on, into our process to enhance what we're doing. But on top of cash flow, we look for balance sheets that are lowly geared. And there's many reasons for that. Gearing is your friend until it's not. Buffett described it as like driving a car along the highway with a dagger facing towards you. It's really good until you hit a pothole, until rates rise, or you have a profit downgrade, and suddenly you hit the steering wheel and you're pretty much a cactus. And small caps, if you've done small cap investing for a while, you know that highly geared companies in a tough economic environment can very quickly deflate and be extinguished by large amounts of gearing. And then finally, we still think valuation is really critical, and we look at valuation to distinguish between businesses. And also importantly, it does help us to avoid bubbles. And one of the, I guess, consequences of the fact that money is going passive in Australia is that we think we're seeing more bubbles blowing up in small caps. And avoiding those and the inevitable deflation of those has been a key part of how we've derived alpha for our clients over time. Now, when it comes to idea generation, we get a lot of questions around how do you guys create ideas? Are you using conferences? Are you using filters? Are you using scans and screens? The answer is yes to all the above. Plus, we're using our curiosity. But I think the magic really is not so much about getting the ideas. It's more about this part down here. So it's sifting through the ideas, digging through them, doing the researching, doing discussion with the team. And I'll come back to this section in a bit and explain how we're adapting how we do that into a modern world using AI. And then finally, it's filters like diversification, liquidity, and risk profile. So you can get cheap companies that are highly risky because they might have 2 customers, or might be cheap but have a lot of gearing. So there's all those sort of things that might filter a stock out at the end of the process. So it's not just the ideas, it's how you process those ideas that I think is where the magic occurs. And then hopefully out of all that process, you generate alpha, the magic alpha. Our team has expanded over the last 9 years. We started out with 3 people, and Spheria has invested in our team, and now we're 9. And a bit like Blake was saying, we also travel overseas, and our team's committed and done 5 global trips over the last 12 months. And looking forward, we think we're doing at least 5 trips again internationally. We do this for 2 reasons. One, we have a global fund, which we're looking for ideas for. And secondarily, and equally importantly, we do it to get ideas for Australian stocks and look at the overseas affiliates of the Australian businesses to see how they're going overseas and bring back any learnings. And it's quite amazing what we get out of these sort of trips. And here's some examples of some names that you'd be familiar with on the right-hand side. You'd have heard of Domain and realestate.com, for example. We own some holdings globally in Baltic Classifieds and Hemnet, which is in Sweden. And in some cases, Australia is ahead of international peers. So in real estate portals, we are actually the world leader. We charge the most, Go Australia. And these are the most profitable portals. And the smarter ones overseas are trying to emulate that charging model. If you look at the list here, you'll see car sales, which we're all familiar with, and Car Gurus is the leading website in the US, and so on and so forth. The other side benefit from this is, other than getting parallels, is we can start to see how overvalued some of these names are in Australia. You know, we've got a lot of money flowing into large Melbourne-based instos. It's going quasi-passive if we're not going passive in actual name. And we think this is causing some massively inflated bubbles. You know, we would call out Pro Medicus here as being a name we think is a great business, but on extremely high multiples. WiseTech, there's quite a few others that we've avoided over time that we think are really expensive. And if you look internationally, you can see comparable companies with similar growth rates at a fraction of the multiple. And I think having that ability to go overseas, look at companies, meet management teams, see a less crowded market gives you some real insights into how we should be valuing companies. Now, I'll take you through a couple of stocks we own and one we don't own, just to kind of bring that process alive and show you maybe how cash flow leads and generates ideas or keeps out of stocks that don't have a lot of cash flow. So the first one is AP Eagers. This was a crowd favourite yesterday in Brisbane, obviously, being a local champion up there. This is the stock price of Eagers. As you all know, it's a major car retailer in Australia. The stock was trading around $14 going back 18 months. Got sold off heavily late last year on the back of fears about the consumer. Rates were high. People were worried about consumer discretionary. Some of the peer groups, so Autosports and Peter Warren Holdings, reported terrible numbers because of inventory overhangs from new cars, margins getting crimped, etc. And of course, you had hedge funds, good old hedge funds, out there shorting the pants off this thing because thematically it was a bad place to be. And this led to a dramatic sell-off in the company. So we did have a small position before this, and then as they got belted, we started doing more work on it. And they also, of course, had just signed up a deal with BYD, Build Your Dreams, the Chinese auto company, which we thought was kind of coming for free. So being curious, as we are at Spheria, I rented a BYD Atto when I was in Brisbane, actually, on a work trip, and took it for a drive. And have you driven an Atto, anyone? It was cute, I'd say. Is that a proper word for a car? It was, you know, the screen turned upside down. It had like disco lighting inside it. It had strange elastic bands on the side that you could put your maps in if you had maps or books. And, you know, it was a capable car, but nothing really earth-shattering, to be honest with you. Someone at BYD got the message and went back and said, hey, let's change the moniker from Build Your Dreams to BYD. Sounds a bit cooler. And if we're going to sell to tradies in Australia, we've got to come up with a macho name. So how about the Shark? Good idea. And of course, they have launched the BYD Shark. It's the first plug-in hybrid in Australia. And this thing is selling like hotcakes. There's the Shark. Just as a small aside, we've trademarked every other major animal in Australia now: BYD Leopard, BYD Orca, just in case they launch bigger cars later on. But this has now seen, BYD is now the top, well, in June it was the 5th largest selling brand in the country. Now, going back to fundamentals, what's it meant? We've shown these charts before where we reconcile operating cash flow and EBIT. It's really core to the process of Spheria, but you can see that Eagers has a really good reconciliation of cash and earnings. This big jump in 2020 was when they bought Auto Holdings and doubled their market share in Australia. The return on capital is very high. So you go through the basics: strong dynamic, leading market share, it's growing, it was consolidating the industry, good cash flow generator. Now the balance sheet, it had quite a lot of net debt, $900 million if you strip out the bailment finance, but actually offsetting that was $900 million of property. So if you really think about it, the business wasn't really actually very geared at all. And late last year, you could bought it on a property adjusted valuation of about 6 times earnings. So that's what led us into that position, and it's done pretty well. Now, conversely, how do we avoid names that are going to be impacted by market downgrades, underperforming assets? And look, Domino's Pizza, again, another Queensland champion, so resonated with the crowd yesterday, but everyone's familiar with Domino's, and we've got a bit of a checkered history because we actually like this company. Historically, we owned this business. It provided great returns for us in our previous guys, and it's a really good, strong business in Australia and New Zealand. But unfortunately, they went overseas, and they expanded into many international markets. They bought into Japan originally, they went into Europe, Singapore, Taiwan. Pretty much throw a dart, and they bought a business there. So they went way overseas, and as part of that process, return on capital started to decline. And also they got commoditized. They were leading with Domino's Pizzas, call up, get pizzas delivered to home, or using the app, and then Grubhub and Uber Eats came along and completely eroded that competitive advantage they had versus some of their peers. And finally, the balance sheet got stretched. So back to our fundamentals, cash flow conversion was strong originally and then went very weak as they moved internationally and had to invest heavily in the core business. Franchisee economics started to deteriorate, and return on capital, you can see, started to fall. Meanwhile, share price is hitting all-time highs. Why? That magic word from bankers, EPS accretion, should be deleted from the lexicon in my view. There's no value accretion, but all the deals are done were EPS accretive, but actually deleterious to fundamental value creation. And so their stock was a dramatic underperform for a period of time. Now, lastly, I want to touch on AI, which obviously is a huge theme. There aren't many stocks in Australia that directly play into AI, but I think, I'll leave you one thought about this. I think that active management teams will inculcate AI into their processes, and it could become a killer app for fundamental investors like us. What does it do for us? Well, two things. One, it will materially enhance productivity. We can read transcripts, we can read annual reports much faster using AI. We can take notes. We can summarize conference calls a lot faster. Some of these things we're currently doing at Spheria, and some of our peers at Pinnacle Stable are also bringing it into what they do. We chat with these guys. And secondly, we're trying to capture, we're not trying to make ourselves the Renaissance Capital, which is a big US hedge fund. Number two, we're trying to basically inculcate, embed, and extend what we do at Spheria and make ourselves more efficient. So we're starting to train AI on data. And equally, in our meetings now, when we have stock meetings, we actually feed our note into AI and say, okay, give us the contrarian case for our view here. And it's amazing. This thing can read through the note, look at the margin assumptions, return on capital assumptions, and come up with some really clever ways that we might be wrong or we might be too conservative in our forecasting. So I think this is something that is really going to be really powerful for active management teams. But you know who can't use AI? Passive. They don't have any ability to use AI. How will they use AI? They're not going to use it for anything. Just buy the damn index at whatever it is. So it is actually going to be something very useful for active management teams. Just to wrap all this up, this chart here just shows you how Spheria has gone versus both our peer group and also the small cap market. We've delivered good alpha over our inception, which is over 9 years now. Importantly, volatility, beta and risk metrics have been lower than the index, which we're proud about. And also, you do get more diversification. We don't have a crowding into gold like the index does at the moment. So to conclude, alpha is the key to what we do. We do it every day. We love doing what we're doing. It comes from avoiding stocks as well. So the Domino's Pizza example, leaving those out, avoiding the bubbles that we've seen in small caps like BNPL and lithium space, where we've seen extreme valuations be corrected. And I think future tools like AI can be inculcated into fundamental bottom-up investors like us, but obviously our peers in passive will really struggle. So the shift to passive in time, I think, does create opportunity for us. And so I'll leave you with a final quote from Louis Pasteur, that great investor. Chance favours the prepared mind, and I think for the right process, we are prepared. Thanks for your time.